You find a trader with a flawless 300% annual return. You hit copy, feeling smart. But then a minor market correction hits, and you watch your entire account vaporize in a single afternoon. That wipeout is entirely predictable. Social trading platforms are built to aggressively push vanity metrics like total return, encouraging you to blindly follow numbers that look great on paper but hide catastrophic flaws. To actually survive and profit, you have to abandon the passive follower mindset. You need to look at these accounts with the ruthless, skeptical perspective of a forensic auditor. We are going to systematically expose the mathematical and infrastructural risks hidden in these profiles, cutting them off before they ever touch your capital. The very first step of a forensic audit has nothing to do with charts. We have to map the technical architecture to see exactly where your capital lives and how trades are actually routed. Most people start with social copying. It relies on signals sent over an API. If your terminal lags or drops connection for even a second, you might miss an exit entirely, leaving you holding the bag on a losing trade. This diagram shows the three main pathways your money takes. Social copying is that fragmented line. The PAM structure pools funds into one unified funnel, stripping your ability to close individual trades. Then the MAM. Funds stay individual, but the manager executes centrally, adjusting risk granularly across independent satellite nodes. Evaluating a trader's risk profile is meaningless if the account module you choose doesn't give you the technical authority to manage your own capital. Throw out total return. The primary institutional benchmark for survival is the recovery factor. This bar chart shows the calculation: net profit divided by max drawdown. Trader A and Trader B both make $10,000 in profit, but Trader B suffers an $8,000 drawdown, meaning a 1.25 recovery factor. You need at least 1.5. As these charts transition into timelines, surviving volatility spikes over 3 years proves true resilience. Once the metrics check out, we hunt for the blow-up signature. A perfectly smooth 45-degree upward equity curve is the single biggest red flag in all of copy trading. That artificial smoothness usually hides a martingale or grid strategy. These traders simply double down on losing positions over and over again to maintain a 95% win rate. This line graph exposes the classic sawtooth pattern. Notice the smoothly rising balance on top, but look at the true floating equity below it. Those deep, sharp downward stabs happen right before a winning trade finally closes to cover the mounting losses. An aggressively smooth balance chart rarely belongs to a genius trader. It usually belongs to a gambler desperately delaying an inevitable account-ending margin call. Even if you find a genuinely brilliant trader, you still have to overcome the follower's tax. These are the unavoidable execution costs that create a permanent gap between their profits and your reality. If your master trader targets a tight 5-pip scalp, your trade might hit the market a fraction of a second later. Milliseconds of delay and wider broker spreads act like friction, completely eroding those tight profit margins before the trade even has a chance. This makes copying high-frequency traders incredibly hazardous, especially if you're on different broker servers. Microsecond liquidity shifts guarantee you will buy higher and sell lower than the master account. Finding a world-class trader is financially meaningless if your broker's execution environment cannot mathematically replicate their exact entry and exit points. The final step of the audit is internal. Most retail traders just click Follow and let the platform's default settings determine their lot sizes. That is a quick way to blow your account. This diagram shows the copy ratio calculation. You must dynamically adjust your position sizes to account for the exact disparities in balance and leverage between you and the provider, giving you a precise fraction to scale your trade safely. Next, you deploy the ultimate defensive tool, the hard stop. You set this at the account level to automatically sever the connection the moment your equity drops by a specific percentage. If the master trader goes on tilt and starts revenge trading, you are instantly disconnected. A history of closed profitable trades only shows you the wins. The final audit step is checking the Open Trades tab. Here, the size of current floating losses reveals the true risk the trader tolerates. Step into the role of a portfolio manager. Eliminate the follower's tax with FXNX's 0-pip spreads. Download our institutional audit checklist and run the risk calculator before you ever hit copy again.